Bismillahirrahmanirrahim. In the previous class, we discussed about sources of information for financial statement analysis, from where you can get information for financial statement analysis. So we discussed about these methods of financial statement analysis. There are different methods of financial statement analysis. The first one is ratio analysis. Ratio is dividing one accounting number by another accounting number and getting some information and then analyzing that. Then horizontal analysis, vertical analysis, index analysis, common size analysis. So these are, and trend analysis. So these are different methods of financial statement analysis. Later on, we will discuss these one by one. Then after that, factors of business survival. Which factors are important for survival of the business? There are two key factors for business survival. The first one is profitability and the second one is solvency. Now, what is profitability? You know about profitability. For the survival of business, the business must be profitable. Profitability is important if the business is to generate revenues in excess of the expenses incurred in operating that business. So if your revenues are high and your expenses are less, so this shows that your business is profitable, and it is very much important for the survival of the business. Solvency. The solvency of a business is important because it looks at the ability of business in meeting its financial obligations. Financial obligations means if a business took debt, so solvency of the business shows that the firm can pay its debts plus interest on time, that they can pay its financial obligations on time. So these are two important factors for survival of the business. Profitability is important and solvency is important. I told you about solvency. Solvency means that you can pay your liabilities, your debts, plus any interest on those debts on time. So that is the solvency. Importance of financial statement analysis. So why financial statement analysis is important? Financial statement analysis will help business owners and other interested people to analyze the data in financial statements, to provide them with better information about such key factors for decision making and ultimate business survival. That is, financial statement analysis will help business owners and other interested people, internal and external parties, just like we discussed previously, to analyze the data in financial statements. So when they will analyze these financial statements, it will provide them with better information about such key factors for decision making. And on the base of that financial statement analysis, they will get information, and on the base of that information, the they will get these information, and on the base of that information they will take decision about the future for the survival of the business. Financial statement analysis is the collective name for the tools and techniques that are intended to provide relevant information to decision making. Financial statement analysis is providing relevant information to the interested parties for taking decision, for decision makers. So it is providing relevant information to decision makers for taking decisions. The purpose of FSA is to assess the financial health and performance of the company. So one main purpose of financial statement analysis is to check the financial health and to check the financial performance of the company. Financial health, you can study the financial health by studying the balance sheet, and financial performance, profitability, by checking the income statement of the firm. FSA consists of the comparisons for the same company over the period of time and comparisons of different companies either in the same industry or in different industries. So in financial statement analysis, one is internal analysis. Internal analysis means that comparing your performance with your past performance. How? Like suppose this is the data of 2019. This is the data of 2018. And this is the data of 2017. Now in 2019, this was our ratio. Suppose our profitability, it is 8% in 2019. It was 10% in 2018, and it was 16% in 2017. So check that you are comparing your present performance with your past performance. Presently, your profit is 8%. In 2018, it was 10%, and 2017, it was 16%. So it is showing that the performance of the company is becoming weak and weak yearly. So on the base of this, you can take different decisions. So this is called internal analysis, comparing your present, this is present, with your past, and this is past years. So comparing your present performance with your past performance, that is the internal analysis. And external analysis is comparing your performance. Suppose this is your performance and this is industry. Suppose in industry, the industry average, all industry average are the market leader in the industry. Their profit, suppose it is 15%. The industry average is 15% and your performance is 8%. It was, suppose it was 13% in 2018 and it was 10% in 2017. So you are comparing your performance with the performance of the industry. So this is what external analysis. So one is internal analysis and the other one is external analysis. In internal analysis, you are comparing your present performance with your past performance. In external analysis, you are comparing your present performance with other industries or the industry averages. So here we perform this thing. So this is basically comparison. Financial statement analysis is the comparisons for the same company over the period of time and comparisons of different companies either in the same industry or in different industries. So you are comparing your performance with your past, or you are comparing your performance with other industries. So financial statement analysis is also helping you to compare your performance with other companies. Financial statement analysis involves analyzing the information provided in the financial statements to provide information about the organization's past performance, present condition, and future performance. On the basis of financial statement analysis, You can check your past performance, you can analyze your present condition, and you can predict about the future performances. Assess the organization's earnings in terms of power, persistence, quality, and growth. You can check, you can analyze your earning power, your persistence. Persistent means that your profit, it is regular, your company, it is regularly in profit. Persistently, your company is in profits, your profits are persistent, stable. Quality and growth, your company is growing, the quality of your earnings and the growth of your company. And the next thing is the solvency. What is the solvency? Assessing the solvency of the firm. So on one side, financial statement analysis is checking the earning power, means the profitability of the firm, and the other side they're checking the solvency of the firm. Purpose of financial statement analysis, it is continued. See, we are studying the importance of financial statement analysis. Importance is continuous. Purpose of financial statement analysis: to use financial statement analysis to evaluate an organization's financial performance, financial positions, prediction of future performance. We discussed about all these, that you can check your present financial performance, you can check your financial position, and you can predict about the future performance. To have a means of comparative analysis across time in terms of inter-company basis within the company itself, internal analysis, and intra-company basis between companies. We discussed this is internal analysis and this is external analysis. Industry averages against the particular industry averages. Now here in intra-companies, you can compare your performance with a single company. And here in industry averages, you are comparing the performance of your company with all the industry averages. To apply analytical tools and techniques to financial statements to obtain useful information to use to aid decision making. So financial statement analysis, it is using some tools and some techniques to obtain useful information from financial statements. I told you ratio analysis, trend analysis, common size analysis. These are the tools and techniques that we are using to obtain information from financial statements. And then we are using these financial statements to make decisions about the future, about regarding the company. Now, what are the financial statements? The main financial statements are the income statement, the balance sheet, the statement of retained earnings, the statement of cash flow, the statement of changes in financial position, that is changes in working capital position, changes in cash position, changes in overall financial position. So these are different financial statements. You know about, I think, majority of these. You know about income statement, you know about the balance sheet, you know about the statement of retained earnings, you know about the statement of cash flow, and the statement of changes in financial position. In financial position, working capital, changes in the working capital position, changes in the cash position, and changes in the overall financial position of the firm. If you know nothing about these, so inshallah we will discuss about these in the next chapter. Effective financial statement analysis. Now the main thing is, one is financial statement analysis and one is effective financial statement analysis. To perform an effective financial statement analysis, you need to be aware of the organization's business strategy. What is their business strategy? What are their objectives? Annual reports and other documents like articles about the organization in newspaper and business reviews. These are called individual organizational factors. Now keep in mind, in effective financial statement analysis, it is important that you have idea about the business strategy. What is the strategy of this business? What is the strategy of the organization? What are the objectives of the firm? Detailed knowledge about the objectives of the firm. Annual reports of the firm and other documents like articles about the organization and newspapers. What are the articles published about this organization in the newspaper, and business reviews, different business reviews. These are called individual organization factors. We call it individual organization factors, which are important when you are doing effective financial statement analysis. Effective financial statement analysis requires that you understand the nature of the industry. The other thing which is important is the nature of industry in which the organization works. This is an industry factor. We call it industry. It is a manufacturing business, it is service business, it is financial institution. Which type of business is this? Which type of manufacturing businesses is? Which type of service businesses is? Which type of trading business this is? You know about this thing that there are three types of business organizations, three type of businesses, business concerns. One is trading, one is manufacturing, and one is service. So it is trading business, it is manufacturing business, it is service business. So it is which type of business in which it is which type of industry in which your firm is engaged. It is a trading business, trading industry, it is manufacturing industry, it is services industry. So which type of business is this? It is important for effective financial statement analysis. Suppose our business is a cement factory. So cement, it relates to this manufacturing business. So we are working in manufacturing industry. If it is a bank, so it will be, it is what? It is a service industry. So understanding the nature of the industry. What is the nature of your industry in which the organization works, in which your organization is working? This is an industry factor. We call it industry factor. Understand the overall state of the economy. What is the state of the economy? Economy is in boom, economy is in recession, economy is in depression. So economy is in which stage may also have an impact on the performance of the organization. Because if the economy is going well, the organization will go well. If the economy is going bad, the organization performance, it will be poor. So this is also an important factor in effective financial statement analysis. So one is the industry factor and one is the economy factor. Financial statement analysis is more than just crunching numbers. It is not just getting numbers from financial statements. It involves obtaining a broader picture of the organization in order to evaluate appropriately how that organization is performing. Don't think that in financial statement analysis we are just getting numbers and these numbers are meaningless. No, these numbers are showing a broader picture of the organization. These numbers are showing the performance of the organization. These numbers are showing the financial health of the firm. So these numbers are very important. Don't think about this, that these numbers are just crunching numbers. These are just numbers. These are meaningless. No, this financial statement analysis, the numbers that we are obtaining, it is very important. It is giving us a broader picture about the performance of the organization and financial health of the organization. Now, different standards of comparisons. Rule of thumb indicators. Financial analysts and bankers use rule of thumb or benchmark financial ratios. Rule of thumb means some ratios. In these ratios, there are some standards. These financial analysts, these are using these benchmark, these standard ratios for comparisons. Suppose, take an example. If your current ratio, it is 1.5, we consider it good. That yes, our financial ratio is good. If it is below, then it is not good. But if it is too much high, it is also not good. So this 1.5, this is a standard. And financial analysts, they are comparing this number, this standard. Suppose this is standard. Now, what is the ratio of our firm? Suppose it is 1.1. So it is showing that our ratio is very weak. We compare our financial ratio with this standard. So this is showing that our ratio is poor. So keep in mind that financial analyst and banker use rule of thumb. Rule of thumb means these standards are benchmark financial ratios. They are using these standards for comparisons. The next thing is past performance of the company. They are using one factor in analyzing the performance of the company is the past performance. They are comparing the present performance with past performance of the company. Just like we discussed that this is 2019, this is 18, and this is 2017. So what is the performance in 2018, 19? What is the performance of 2018 and what is the performance of 2017? So these past performances, these are a standard for measuring current performance. So this is the current performance, and on the base of this current performance, we are comparing this current performance with the past performances. So they are also using the past as a standard for comparing the present performance. So present is compared with the past. So that is another standard for comparison. Past performance with present performance. So past performance of the industry standards. Another, comparing your performance with other industries, other companies in the industry. Suppose there is one company, you're comparing your performance. Suppose this is your company A, and this is a company in the industry B. So you're comparing your performance with this company's B's performance in 2017, in 2018, and in 2019. Suppose this. So this is also used as a standard. You are using industry average. All industries, all companies in the industry, you're calculating their average. And you're comparing your performance, your 2019 performance with this industry average. Okay, I'll make a bit clear. Like see, this is your company A. And this is industry. All the companies in the industry, we will take their average, industry average. This is 2019. This is 2018. And this is 2017. So this is your performance in these 3 years, and this is the industry average, means all the companies in the industry, we are calculating their average, and this industry average is compared with your company performance, present performance. So this is another standard used for comparison, that is called industry standards. Sources of information, we discussed about this: company reports, directors reports, companies directors reports, financial statements, schedule and notes to financial statements, we call it disclosure. We discussed about this in auditing, and the auditor's report. These are sources of information for financial statement analysis. Stock exchange, performance of your company in the stock exchange, business periodicals, different business periodicals which are publishing reports on the performance of different companies, and information services like Moody, like Standard and Poor's. So these are different information services. They are providing information about the performance of the company. So all these are the sources of information for a company. Different tools of financial statement analysis we already discussed. One is financial ratio analysis, comparative financial statement analysis like horizontal analysis, trend analysis, vertical or common size analysis, or component percentages, that is trend analysis. So these are the tools of financial statement analysis. Limitations of financial statement analysis. We must be careful with financial statement analysis. Strong financial statement analysis does not necessarily mean that the organization has a strong financial future. Now, keep in mind one thing. We are measuring today's performance. It doesn't mean that the company's performance will be good in the future. It is not guarantee. Financial statement analysis is not guarantee of this thing, that the performance of the company will be good in the future. The next thing is, this is one limitation, this is one weak point of financial statement analysis. Financial statement analysis might look good, but there may be other factors that can cause an organization to collapse. Now, financial statement analysis, we are just using the accounting numbers for analysis, but maybe there can be some other factors which are which are important in the success of organization, and we are not focusing on that. So the organization collapses, like management, like different other factors, and mostly the most important one is management. Now, financial analysis is only means, ignores the price level changes. It doesn't show. Okay, it will take time. So inshallah, in the next class, I will discuss about the limitations of financial statement analysis in detail. It will take time. It will take time. So, okay, inshallah, in the next class, then we will discuss about all these things. Have a good time.